In the thin air of the Altiplano, where the Andes Mountains scrape the sky at 13,000 feet above sea level, a banking empire rose and fell over nearly 6 decades. Banco Mercantil Bolivia began operations in 1945, promising to bring modern financial services to one of South America's most isolated nations. The bank's founders, a consortium of wealthy tin mine owners and European immigrants, established their headquarters in La Paz, the world's highest capital city, with branches scattered across Bolivia's impossible terrain. From the beginning, Banco Mercantil positioned itself as the financial lifeline for Bolivia's mining industry, handling everything from payroll deposits for workers in remote mountain camps to international currency exchanges for precious metal exports. By the 1960s, the bank had grown to control nearly 30% of Bolivia's total banking assets, with over 200 branches spread across a country where some locations required mule trains to deliver cash and documents. The bank's early success stemmed from its willingness to operate where no other financial institution dared, establishing outposts in mining towns accessible only by treacherous mountain roads that claimed lives regularly during the rainy season. The geographic challenges that made Banco Mercantil indispensable also created the perfect conditions for systematic corruption. Bolivia's Central Banking Authority, established in 1928, struggled to maintain oversight of financial institutions operating in regions where government officials could only visit once or twice per year. The country's rugged topography meant that bank examiners from La Paz required 3 days of travel to reach some remote branches, and communication with headquarters often relied on radio transmissions that frequently failed during mountain storms. This isolation allowed Banco Mercantil's regional managers to operate with unprecedented autonomy, making lending decisions and handling deposits without immediate scrutiny from either bank headquarters or government regulators. The situation worsened after Bolivia's 1952 revolution, which nationalized the major tin mines and created a chaotic political environment where regulatory oversight became even more sporadic. Bank employees in remote locations quickly realized they could manipulate records, create phantom accounts, and embezzle funds with little risk of detection, as long as they maintained enough liquidity to handle routine transactions from local customers. The first major embezzlement scandal surfaced in 1967 when auditors discovered that the bank's Potosi branch manager had created 43 fictitious accounts over a 5-year period, systematically siphoning approximately $2 million into personal investments. The manager, Carlos Mendoza, had used his position to forge loan documents for non-existent mining equipment purchases, then transferred the funds to accounts he controlled in Argentine banks. The scheme only came to light when a clerical error led to duplicate monthly statements being sent to a legitimate customer who noticed discrepancies in account numbers that matched the phantom accounts. Internal investigations revealed that Mendoza had bribed local telegraph operators to intercept communications between the Potosi branch and La Paz headquarters, allowing him to control the flow of financial information and delay discovery of his activities. The scandal shocked Bolivia's banking sector, but Banco Mercantil's board of directors chose to handle the matter quietly, firing Mendoza and absorbing the losses rather than reporting the full extent of the fraud to banking regulators. This decision established a dangerous precedent of internal cover-ups that would plague the institution for decades to come. Throughout the 1970s and 1980s, Banco Mercantil expanded aggressively despite mounting evidence of systemic corruption within its ranks. The bank opened new branches in remote jungle regions of eastern Bolivia, where coca cultivation was becoming increasingly lucrative, and these locations proved even more difficult to monitor than the mountain mining towns. Branch managers in cities like Santa Cruz and Trinidad began handling large cash deposits from agricultural businesses that later proved to be fronts for drug trafficking operations. The bank's internal audit department, headquartered in La Paz, consisted of only 12 employees responsible for overseeing more than 300 branches spread across a country larger than Texas and California combined. Auditors typically spent no more than 2 days at each location during their annual visits, relying primarily on documentation provided by the same employees they were supposed to be investigating. This superficial oversight allowed corruption to metastasize throughout the organization, with branch managers sharing techniques for manipulating records and covering up unauthorized transactions. By 1985, internal estimates suggested that fraudulent activities were occurring at more than 60% of the bank's remote locations, but senior management continued to prioritize expansion and profit margins over implementing effective controls. The complexity of Bolivia's political and economic landscape during this era provided additional cover for Banco Mercantil's corrupt practices. The country experienced over 190 governments between its independence in 1825 and 1982, creating an environment where regulatory continuity was virtually impossible. Hyperinflation reached an astounding 24,000% in 1985, making it extremely difficult to track the real value of assets and liabilities across the banking system. Currency devaluations occurred so frequently that bank employees could manipulate exchange rates for personal gain, converting Bolivianos to dollars at artificially favorable rates for themselves and their associates. The bank's foreign exchange operations became a particularly lucrative source of illegal profits, as traders could exploit the time delays in communication between remote branches and headquarters to execute unauthorized currency transactions. Government banking inspectors, when they occasionally appeared at branch locations, were often unfamiliar with the latest regulatory requirements due to constantly changing political administrations and economic policies. Many inspectors could be bribed with relatively small amounts of money, as their government salaries were frequently months in arrears due to Bolivia's chronic fiscal crisis. International banking relationships inadvertently enabled Banco Mercantil's corrupt activities to expand beyond Bolivia's borders. The bank established correspondent relationships with financial institutions in Miami, Panama, and the Cayman Islands, ostensibly to facilitate legitimate international trade financing for Bolivia's mineral exports. However, these relationships provided convenient channels for moving embezzled funds out of Bolivia and into accounts where they were virtually impossible for Bolivian authorities to trace or recover. The bank's Miami correspondent relationship proved particularly problematic, as several Banco Mercantil executives used their access to wire transfer systems to move millions of dollars into personal accounts at Florida banks. These transfers were disguised as routine business transactions, such as payments for mining equipment or import financing, making them difficult to distinguish from legitimate commercial activities. The Federal Reserve and other U.S. banking regulators had limited visibility into the ultimate source of these funds, and Bolivian banking authorities lacked the resources and expertise to monitor international wire transfers effectively. By the early 1990s, U.S. Drug Enforcement Administration investigations began uncovering connections between Banco Mercantil's Miami operations and money laundering schemes involving Colombian drug cartels. But the bank's executives successfully argued that they were unwitting victims of sophisticated criminal enterprises. The advent of electronic banking systems in the 1990s initially appeared to offer hope for better oversight and control of Banco Mercantil's operations. The bank invested heavily in computer systems and satellite communications technology designed to provide real-time monitoring of transactions across all branches. However, the complexity of implementing new technology across such diverse and challenging geographic locations created new opportunities for fraud rather than eliminating existing problems. Many remote branches experienced frequent system outages due to power failures and equipment malfunctions, forcing employees to maintain parallel paper-based records that could be easily manipulated. The bank's information technology department, based in La Paz, lacked the expertise to properly configure fraud detection algorithms for Bolivia's unique operating environment, where legitimate transactions often exhibited patterns that would be considered suspicious in more developed banking markets. Corrupt employees quickly learned to exploit system vulnerabilities, creating electronic records that appeared normal to automated monitoring systems while concealing unauthorized activities. The bank's senior management, most of whom had limited understanding of computer technology, relied heavily on technical staff who were themselves involved in fraudulent schemes and had strong incentives to downplay system security weaknesses. As Bolivia's economy stabilized in the late 1990s and international pressure for banking sector reforms intensified, Banco Mercantil faced increasing scrutiny from both domestic and foreign regulators. The International Monetary Fund made banking sector transparency a condition for continued financial assistance to Bolivia, forcing the government to implement more rigorous oversight procedures. New banking laws required more frequent audits, standardized reporting procedures, and criminal penalties for bank officers who facilitated money laundering or other illegal activities. However, these reforms came too late to save Banco Mercantil from the accumulated damage of decades of systematic corruption. In 1999, a comprehensive audit conducted by international accounting firm Pricewaterhouse revealed that the bank's reported assets were overstated by approximately 40%, with hundreds of millions of dollars in non-existent loans and fabricated deposits appearing on the books. The audit uncovered evidence of fraud at virtually every level of the organization, from tellers who had stolen small amounts over many years to senior executives who had embezzled tens of millions of dollars through complex schemes involving shell companies and fictitious investment programs. The bank's board of directors, many of whom had been involved in or aware of corrupt activities for years, finally acknowledged that the institution was effectively insolvent and could not continue operations without massive capital injections that no investor was willing to provide. The final collapse of Banco Mercantil Bolivia in 2003 sent shockwaves throughout the country's financial system and highlighted the devastating consequences of allowing geographic isolation to shield corrupt practices from oversight. Government investigators ultimately determined that total losses from fraud and embezzlement exceeded $600 million over the bank's 58-year history, making it one of the largest banking fraud cases in Latin American history. More than 200,000 depositors lost their savings, including many small-scale miners and rural farmers who had trusted the bank with their life savings. The collapse triggered a broader banking crisis in Bolivia, as customers rushed to withdraw deposits from other financial institutions amid fears of similar corruption. Criminal prosecutions resulting from the scandal led to prison sentences for 47 former Banco Mercantil employees and executives, although many of the most culpable individuals had already fled the country with stolen funds that were never recovered. The Bolivian government was forced to implement an expensive deposit insurance program to restore confidence in the banking system, and new regulations required all financial institutions to implement real-time electronic monitoring systems with direct connections to central banking authorities. The story of Banco Mercantil serves as a stark reminder that geographic challenges, while creating opportunities for financial institutions to serve underserved markets, can also provide perfect cover for systematic corruption when proper oversight mechanisms are not implemented and rigorously maintained.